Lesson 5. The Dual Frame Top Strategy Explained. The top indicators are trend-following indicators. That means that they only work when the market is trending. Otherwise, they will give you false signals. Hence, it is of vital importance that the trader first identify the trend. But here is an important challenge we have to make you aware of. The trend of any market is usually up, down, and sideways at the same time, depending on what time frame you use. While the trend in a daily chart may be up, if you looked at a 4-hour chart, it may be sideways, but clearly down in a shorter time frame. Let's examine this in more detail so you are better familiarized with a key aspect of our dual frame top strategy, DFTS. For example, this is a daily chart of the euro. The downtrend line clearly defines this trend as down. So does the slope of the moving average. However, at the very same time, the trend is sideways on a smaller time frame. On this 4-hour chart, you can clearly see the trend lines converging. That's a typical sign for triangles, the most obvious expression of a sideways market. The moving average also flattened in the last part of the chart, and as you have already learned, that is a sign of a market that is in a consolidation process. Once we move to a smaller time frame, such as in this case, we are using a 15-minute chart. There we can see a clear uptrend defined by the 45-degree uptrend line and the slope of the moving average. These 3 charts of the same market viewed at the very same time show 3 different trends. The daily chart is in a downtrend, the 4-hour chart is in a sideways trend, and the 15-minute chart is in a clear uptrend. So what trend should we consider at the time of taking our trade decision? We need a clear system that allows us to handle all this conflicting information indicating direction of the trend. And that's precisely the reason why we created the dual frame top strategy. In top, we have observed that every time frame relates to a larger or shorter time frame by a factor of 5. This is approximate, but it works very well for our trade setup. That means that if you want to scalp using a small time frame, you would use a larger time frame to identify the trend and determine the direction you're going to trade. We call this larger time frame the reference frame, or RF. The shorter time frame is called TC. That stands for trigger chart. For example, if your lower time frame or trigger chart is in 5 minutes, your reference frame, RF, should be 25 minutes. Obviously, if you are a swing trader who prefers to keep positions overnight, you will need to adjust these time frames to 60 minutes for your trigger chart and 300 minutes as your reference frame. So for our dual frame top strategy, we will combine 2 time frames related by a factor of 5. We will be taking our trades from the shorter time frame. We call it trigger chart because it is from this chart where the trade signals will be triggered and executed. We're going to assume that the majority of our top members are day traders who hold positions for less than an hour. So we recommend you use the combination of 5 minutes as a trigger chart and 25 minutes as your reference frame. This dual combination can be very useful because it allows for quick scalps as well as small swings. The larger reference frame, in this case the 25-minute chart, will be used solely to identify the trend and determine the direction in which we are going to trade. That means that if the trend is up on the reference frame, declines on the 5-minute chart will create buying opportunities when price resumes upward. If the trend in the 25 minutes is down, 5-minute rallies will allow us to shorten the market when the top indicator gives us a sell signal. And this is key. In fact, it is the most important filter to use with top. And at the same time, it is also the one that is most often neglected. So take notes and never ignore this key issue. If the trend is up on your reference time frame, declines on your trigger chart will be used to buy the market with the help of the top buy signals. And if the trend is down on your reference time frame, rallies on your trigger chart will be used to sell the market with the help of the top sell signals. Here is an example of a downtrend in the ES. For this example, I am using a combination appropriate for swing traders. So as a reference frame, I'm using a 300-minute chart. As you probably remember, the sole purpose of the reference frame is to help us identify the trend and the direction in which we are going to trade. In this example, the slope of the moving average has changed from up to down, and we get a close below the moving average. For all intent and purpose, this defines the trend as down. So what should we do after we see the first close below the moving average that is already pointing down? The first step, that of identifying the trend, has already been done. We know the trend is down and we got a close below the moving average. Our job now is to switch our attention to the trigger chart, which in this case, respecting the factor of relation by 5, is the lower time frame of 60 minutes. If we were scalping, we would be using a 5-minute trigger chart combined with a 25-minute chart as a reference frame. That's our dual chart trend system. Because the trigger chart is the one from which we would be taking and executing our trade signals, it is only on this chart that we would be placing the top indicators. The reference frame does not need anything else other than the 30-weighted moving average. This here is the lower time frame, our trigger chart with the top indicators on. Notice how the first 3 sell signals were invalid. Why? Because they occurred before prices closed below the moving average in the reference frame. So for us, at that point, the trend was still up. In order for us to consider that the trend had changed, we needed to see a close below a downslope moving average. The real valid signals occurred in the middle of the chart. It was then that we had our first 2 conditions for a valid trade. First, the trend was confirmed as down by the reference frame. That was done by the closing below the downslope moving average. And second, we had a rally in the trigger chart allowing us to take top sell signals. While prices stay below the 30-period moving average in the reference frame, every rally in the trigger chart should be considered as a sell opportunity. But you can see one sell signal that I didn't consider as valid. It is the one in the middle of the chart where I drew a circle. That signal did not work. The question is, was that a valid signal? The answer is no. But we will clarify why that signal should have been ignored in the next videos. We will also discuss how to properly identify the direction of our next possible trade and what constitutes a valid buy or sell signal using the top indicators.